all set? Welcome, you're listening to The Best of Investing on Talk 910. I'm your host, Edward Brown. I'm proud to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing mortgage investment firm, Rob Spinoza of RPM Mortgage, and financial and investment advisor Mike Zaidlin of Madrone Investment Advisory. Our phone number is 888-912-1190. You're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. Now, the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. The vacations are free. Their only request is a $75 cleaning fee to cover those housekeeping expenses. Today's trivia theme is math, everybody's favorite subject. Actually, I like math. Okay, our website is bestofinvesting.com. Check us out on television, Comcast Channel 26 and AT&T Channel 99, Saturdays at noon and Sundays at 6 p.m. Now, first thing I want to mention, ask Mark, you've got a book launching coming up.
I do. I've written a short book for real estate investors. Short meaning it's about 70 pages. It's an easy read. You can actually read it in one sitting, and you'll probably be so riveted that you are very likely to. It's called The Insider's Guide to Attracting Private Money. And what it's about is answering the question that I've gotten probably a couple hundred times over the course of the last 6 years of my career as a private money mortgage broker, a hard money lender. And that question is, hey Mark, where can I go to find my own private lenders? And so I wrote this book to answer that question, and I call it The Insider's Guide because I am an insider. I've been attracting capital for the majority of my career in real estate. In fact, I've attracted over 500 names of private individuals who have contacted me since 2008 when I started Pacific Private Money. Over 500 individuals who have called me and asked to be put on my distribution list for trustee investments, because as you recall, if you're a listener to this program, you know that at Pacific Private Money, we serve 2 clients. We make real estate loans to real estate investors who can't get money from banks, and we fund those loans using private individual capital. So I have one of the more successful rates of attraction of private individual investors to my company, and so I've gotten a lot of people who've called me over time and said, so what's your secret? What are you doing? Now, one might ask, why would someone who's a private lender, why would I give away the secrets? Why would I help a real estate investor go find his own private lenders? Wouldn't I be shooting myself in the foot?
Exactly.
The answer is no, and I'll explain why. In fact, many of my best real estate borrower clients, these are real estate investors who are looking to buy, fix, and flip real estate, or maybe to collect real estate. They never have enough capital of their own. They never have enough equity capital. And so a lot of these guys are in need of equity partners. And so what I teach in my book and what I advise in my book is I'll help you go out and find people that you can partner up with as an equity partner. And then what you want to do, because the goal, the name of the game is you want to make your equity partner rich. It's all about the money. It's all about him. And so the way you do that is you don't go out and do all cash deals with your equity partner. You get an equity partner who provides the equity slice. Then you leverage that with either bank capital or, in my case, with a hard money loan. So
it's kind of a feeder business for you, potentially.
Well, that's the goal. Now, I also know in my business that borrowers tend to outgrow me. So they'll come to me maybe for the first few projects or a bunch of projects, maybe for a year or 2 or 3, and then they become either bank financeable or they have their own capital that they're able to do it on their own, and so they don't need to pay those high hard money rates. But there are plenty of people out there for whom being able to find and attract private individual investors of their own would be something of high value. And what I share in the book is that people with money are looking for people who can help them grow that money. And so that's, of course, my pitch at Pacific Private Money. I share with people how they can earn 8% or more on their savings by funding our trust deed secured loans.
Yeah, because the typical situation is, people would go to friends and family for that equity capital.
Right, exactly. And when you've exhausted friends or family, or your friends and family just laugh in your face at the idea that you could actually help them make money on their money, that there's a trust issue oftentimes.
Sure.
And there's some people who just don't want to borrow from friends and family for a lot of good reasons.
Right.
So where do you go? So what do you do? What do you say? Where do you go? How do you present yourself? And so the book is really a primer on how to become attractive. And I have this what I call my 5 steps to money method. And again, the book is a fairly quick read. It's called The Insider's Guide to Attracting Private Money, and you can find it at attractingprivatemoneybook.com. Now, I know that's a mouthful, and of course it's all one word, but go to the website, attractingprivatemoneybook.com.
But you're also having a launch party?
Well, yeah, we should
party!
The launch date is next Wednesday, February 25th. So if you go to the website today, you'll still see that we're in pre-launch mode, but once it's Wednesday at 9 a.m., that will turn into a Kindle website. So
I was just going to say, are you going to be on Kindle?
Yeah, so there's a Kindle version and a paperback version. I've already ordered actually a couple dozen paperback versions that I'm giving away to friends and associates, but it does launch on February 25th. So if you're a real estate investor and you'd like to learn some insider secrets on how you can find and attract your own private capital to help you leverage your way into real estate wealth and riches beyond your wildest dreams.
But wait, there's more.
Well, there is. I might as well tell you that if you read the book and you like it and you want more, there actually is an additional product that I've spent the last 2 years creating, and that is a video series on attracting private money that goes into even greater depth and includes a bonus DVD of dozens and dozens of templates that I've collected from some of the best real estate investors that I work with, and it will help you even better and quicker to watch your way through. So, but again, the book is the book, and if you like the book and you want more, there's an opportunity to invest in an additional product. It's, again, The Insider's Guide to Attracting Private Money. So if you're interested, go to attractingprivatemoneybook.com.
Very cool.
Yeah.
Good.
Mark,
Oops, we lost you.
Mark, I have a question in general. What percent of your borrowers would you say are borrowing to and planning to stay in the house for the long term versus planning to just buy and flip?
I would say if we do 20 transactions in a month, and that's a fairly typical month for us, 4 to 5 of those transactions in the last year, in 2014, have been these bridge loans for people who are buying a home to stay in. Now, they don't want to keep our money. They're using a hard money loan at 10% and a couple of points to acquire the property for any number of reasons why they might not be able to get bank financing to close. Either it's too quick or they've got a credit glitch or something. But it's 20 to 25% of our deal flow now is short-term bridge loans to help people acquire real estate that they want to move into and stay long-term. It's pretty amazing, and that wasn't the case 2 years ago.
2 years ago, it was all.
It was 75% fix and flip, and the other 25% was just oddball stuff. But the bridge loan, the people using hard money to acquire a primary residence, is a relatively recent and new phenomenon, thanks to Dodd-Frank in many parts because of how
figure.
Because of how difficult
unintended consequences. Right, exactly. Never heard of that.
Yeah.
Okay, tell you what, we're going to cut to our first commercial break here, and the trivia theme is math. Give us to the 500th decimal level pi. No, I'm just kidding.
Okay.
Okay. What do you call an angle more than 90 degrees and less than 180 degrees? Again, we're talking math here. What's the name of that angle called? The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. What do you call an angle more than 90 degrees and less than 180 degrees? All right, stay with us. The Best of Investing will be right back. Okay.
Obtuse?
Hey, stop being so obtuse.
Is it?
I thought we were friends. Then we can just give ourselves nicknames. Hey, he's very acute. I'm very acute.
That's good.
Or she's very acute.
She's very acute.
Yeah.
Yeah, that's fine. I actually, that was the only angle term I know. So. Right. The other one.
Let's see. This is BOI 21st. So what's going to happen with Bruce Jenner? I understand that he was the cause of the crash, or one of the major.
You're talking about Mrs. Jenner?
You know, it's so funny. I still remember, man, that guy was the man.
That guy had the world in his pocket.
Oh, good looking wife, and just, man, he just,
I was a kid. He was on Wheaties boxes.
Yeah.
I mean, that was when, decathlon mattered. People,
Yeah, exactly.
He was an all-American hero.
Oh, yeah. I mean, I remember him waving the flag. And,
I guess we'll never understand it, obviously.
Yeah.
It's beyond our
My wife tries
experience,
to get me to
hopefully.
understand stuff like that. And
I don't even think his wife understands it.
Yeah,
well.
Either wife.
Yeah.
Of course, you marry a Kardashian. And,
Yeah. That might make
you
me
can take
turn.
your gonads
Yeah.
right away.
Isn't it ironic? Here's the family of daughters who get all this attention for doing nothing, and now dad has to come in and out even publicize them all.
Nobody saw that coming.
And the kids, they
What are the
knew
odds?
they knew nothing about who this guy was.
That's crazy.
Maybe it was the ego thing for him. He was going to be one of the girls.
Jesus.
All right, ready? Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hoff, Rob Spinoza, and Mike Zaitlin. When we cut to the first commercial break, we asked this trivia question. What do you call we're talking math here, what do you call an angle more than 90 degrees and less than 180 degrees? And got a little trigonometry hat on, and what'd you come up with?
I blurted it out. I said obtuse.
And we said, stop being so obtuse with us. Okay,
Well,
that is correct.
You get called that enough, and then you know what it means.
You didn't even need a protractor for that one. Okay. Mike, you have a couple of interesting articles for us, or interesting stuff?
Well, the first article was why the wrong Social Security claiming strategy can cost you upwards of $200,000.
That's kind of important.
Yeah, it's kind of important when you're in retirement.
Wow.
Yeah. So what a lot of people don't realize is Social Security increases by about 8% a year for every year that you postpone it from ages 62 to 70.
Okay.
And so add that up, and it's about 75% more for each person. For a couple, there are things that actually make that even more complex. One is the existence of the spousal benefit. Most people, I'm not sure if they realize it, but the lower earning spouse is entitled to half of what the primary earner gets at full retirement age. So, for example, if the primary earner is going to be getting $2,500 at age 66, the other spouse, whether or not he or she has ever worked, is entitled to $1,250 at age 66. And so a lot of times both spouses are obviously working. And so one thing that people really need to realize is you really want to maximize the amount that you take, because the surviving spouse will step up to the higher of the two benefits upon the first death, the spouse's death.
So when the oldest person turns 62, then that's when they really need to start making a decision, right?
Well, exactly. Because 62 is the earliest that you can claim a Social Security worker benefit, of course, unless you're disabled. Surviving spouse can actually claim it at age 60, but that's something that we'll talk about a little later on. But normally you do not want to take Social Security at 62, and ideally you don't want to take it at 66. You want to take it at 70, max it out. The only time you would not want to do that is if you're an individual and you don't expect to live to age 80, you wouldn't want to do that, because that's the break-even age.
Yeah, I was going to say, because if you collected the money at age 62, you could theoretically invest it somewhere.
Sure.
I guess it depends on the rate of return on those earnings.
But for a couple, because the surviving spouse steps up to the higher of the two benefits, if one of them lives past 80, then you want the higher earning spouse to wait until he or she is 70, because it's no longer an individual decision. It basically becomes a joint and survivor.
How many people do you think take that into consideration? You get a
Well,
pool of 100 people.
5?
Maybe,
Yeah,
maybe
I mean,
5 to 10.
Right.
Because of the step up, I'm not sure if most people even realize that.
Are there people who are experts in that arena? Because there's a lot of
Social
decisions.
Security?
Yeah.
Well, I don't know exactly what defines an expert in that field, but you want to be able to run expert software with the data for each client. So each each person should bring in their entire Social Security work history and have it run through a program that determines what the best strategy is. Because I think there are upwards of 2,000 rules within Social Security that can tell you, for example, well, should I take the spousal benefit early and then go up to the worker benefit?
Yeah.
Should I knock my spouse off? That's probably not part of it.
Well, that's part two.
That's part two.
It's all part of the calculation.
So you have to realize Social Security is a really important retirement planning tool. The other thing is it's tax favored. So,
Right.
for example,
We see that. Yeah.
As a couple, you can have up to $64,000 in Social Security benefits, and if you had no other income, you would be paying probably no tax.
Right.
So Social Security is much more tax favored than, say, an IRA or even your own wages. Not only that, it's inflation adjusted. So it's basically a government guaranteed, inflation adjusted, tax favored joint survivor annuity.
Well, good thing we don't have to fund that, because if we did, Jesus.
Yeah. It's free. Remember, it's all free money.
So those
I assume you have a software.
Yeah.
Okay, and it's available in other places. You just want to make sure you're using the right one. There are a lot of Social Security calculators out there, but they really vary in quality. You have to be making sure that it's calculating spousal benefits, looking at various claiming strategies. Things can get very complex once both spouses turn 66.
It sounds like the kind of thing that even though the software is out there, a couple probably shouldn't try this on their own.
Right.
I would think that they should sit down with an advisor. It's sort of like, the average person can read case law, but do they really want to act as their own attorney?
I'll give you another example. We use the rent versus own calculator all the time in mortgage. And part of those, I tell first-time buyers this all the time, part of those calculations, the results that come out are based on your projections of what you'll earn in investments, what the property will appreciate. If those are not realistic, your rent versus own could be valueless.
Well, and then the other issue is, well, even if the calculator tells you what to do, you'll have to figure out, how do I finance that?
Right.
If, for example, the calculator says, well, wait till you're both 70. Well, maybe that's easier said than done, and maybe you're not aware of all the options that you might have. For example, some couples say, well, no, we're going to take it at 62. We need $90,000 a year. We can get $45,000 in Social Security. Let's take $45,000 from our IRAs. Instead of doing that, their better option potentially is to say, no, let's postpone Social Security till 70. Let's then collect $70,000 when we're 70 years old. Accelerate IRA withdrawals now, and then take $20,000 in IRA withdrawals when we're 70, going on, in order to maximize our after-tax return. Because doing that would probably save about $12,000 in taxes.
I'm going to guess, though, psychologically, it's hard to not take it early. I mean, if the government's going, here you go, I guess that's hard to make that decision.
Well, it's hard until you're presented with objective evidence showing that you're going to end up with a lot more in Social Security benefits if you do wait, and then you're going to take more from the government. So that should apply to everyone.
Depends on how long you live.
Everyone's.
But you're not going to get that from a calculator either. That's what you're saying, Edward. You're going to get, you got to consult somebody to get that level of analysis.
Well, and it's just part of financial planning.
Right.
It's hard to separate out the pieces and say, well, this piece I can do myself. Everything fits within everything else.
Okay, well, we're going to give the audience your information now, and then we'll give it to them again after we read an email question for you. But if people are interested in this calculation.
Sure. Well, I can be reached at 415-785-4585, and on the web at madronellc.com.
It's a nice, simple, easy one. Not like getmybook.com. No, just hassling mark.
AttractingPrivateMoneyBook.com.
Say it 2 more times, please.
AttractingPrivateMoney.com. Okay, see, I got it. All right, I got that now.
MadroneLLC.com. Many fewer letters.
Maybe.
The last few pages of your book address Social Security and trustee overlap, right?
Yeah, something like that. Actually, I did.
That's the next version.
I started reading the book, actually. I enjoyed it. I understood it. I enjoyed it.
It made sense.
It did. Tell you what, next week we are having another special. This week is the special trivia contest where the winner is going to get an overnight stay at the McCaffrey House in Twainhart. Got something a little bit out of the geographic area here. So McCaffrey House Bed and Breakfast, the 4 Diamond Inn located in Twainhart. Let's see here. It's It's an enchanting mountain lodge nestled in a quiet forest hollow of the High Sierra, within an hour of Yosemite, and Calaveras big trees. So you can awaken each morning to a fabulous full breakfast and enjoy your day with a wine social. Enjoy hiking, biking, live theater, Gold Rush towns, wineries, skiing, golf, and so much more. Call 888-586-0757 or visit McCaffreyhouse.com. And that's MCAFFREY.com. So here's the question. What do you get when you mix copper, zinc, and nickel? All right, now here are the rules. No previous winners on the Best of Investing. Always want to give it to new people. And you have to email Edward at bestofinvesting.com the answer by midnight tonight. Next week, we will choose from among the correct answers, and choose a random winner there. Okay, so now we're going to go to our second commercial break here. Real trivia question here. Not the real one, but the one for the Lighthouse Resort. Okay, here's this question. What's a polygon with 4 unequal sides called? Now, the first 3 callers with the correct answer to that question are going to win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912. Mark's looking at me going, I'm going to wring his neck.
Obtuse.
Yeah, the answer is obtuse for everything. No. Okay, so what's a polygon with 4 unequal sides called? All right, stay with us. The Best of Investing will be right back.
Who is a rhombus?
What is a poorly built home?
Yeah.
Rhombus?
Yeah, a rhombus.
Maybe. I'm not saying.
I think it is a rhombus.
I think it is. Yeah. A trapezoid has equal angles on the sides.
Yeah, I have to work out my trapezoids.
Don't keep us in suspense.
I have a trivia question,
Yes.
and it's about the Best of Investing.
Uh-oh.
Who said, when it comes to compound interest, those who understand it earn it, and those who don't pay it?
On this show, who said that?
Not on this show.
Oh. Einstein?
Unless he's come back from the dead. I can't believe it. Einstein.
Is that right?
Yeah.
Thank you.
Should we start calling you Einstein?
Yeah.
That's obtuse.
Because you know what? I knew that Einstein, his
It's a great line.
his thought was, the theory of relativity, the child's play, compound interest, baby. That's where it's at.
Yeah.
Speaking of obtuse, there was that great line in Shawshank Redemption, right?
That's
Right.
right.
No, that's what I thought of.
He said,
Yeah. I
He says,
got an extra month in
why are you
jail.
being so obtuse?
Yeah.
Yeah.
How can you be so obtuse?
Yeah, there you go. That's what it is.
What did you call me?
Yeah.
Obtuse. I know what I mean. That's a great movie.
That was an awesome movie.
One of my favorites.
One of the
Yeah,
best,
my
yeah.
top
Good estate planning advice in that movie, too.
Yes.
He does compound.
I know.
Yeah, you remember that.
Like, he goes
Yeah,
up to
when
the
he's ready to
guard
throw
on
up,
the roof and says,
yeah.
you
love your wife.
Oh, yeah.
It's like, then you could just leave it to this beneficiary. And blah, blah, blah,
And
blah,
maybe
blah.
that was the rules back then.
Yeah.
Yeah. I watched that.
Like Gotham beers.
Yeah,
Greatest
exactly.
estate planning advice in the world.
Can people pay their fee with you with beer?
6-pack will do it. And for my buds.
Yeah, that's right, exactly. That was again, I know it's a movie, but it's like that was really smart. Getting good with the fellas,
Everything about that movie
Is Rob going to get his time, or are we going to go on the email?
Yeah, well,
whatever. Yeah, no, I mean, these are just little, what do they call them? Infographics or whatever.
Oh, you're going to share a graph?
Well, I'll tell you what, why don't we go into
Kind of something.
email, and I'll ask you your email question.
Sure.
Okay, here we go. Well, welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hahn, Rob Spinoza, and Mike Zablin. Hey, we should form a band. We could be like Fab Four.
Yeah.
Okay. Let's see. The trivia question here was, what's a polygon with 4 unequal sides called?
Rob got that one again.
Rob, what's the answer?
A rhombus.
Is
Is
no,
it?
not a rhombus.
It's not a rhombus. I didn't get it then. My
And it's
colleagues
not a trapezoid?
sold me out.
It's not a it's not a trapezoid. It's quadrilateral.
Oh,
Quadrilateral. Hey, we gotta
Forgot
make
about
these
that
things
one.
harder for you guys, Okay, so now, Rob, though, we will let you answer this question, which is one of an email. But
now I'm really
listener.
scared.
Yeah, you're really scared. Okay, yeah. How many quadrilaterals does it take? Okay,
To me,
we'll
obtuse.
exactly. Okay.
3.14.
Yeah. Well, you guys are on
5,
today.
6, 7, 8.
Okay, will refinancing cause my real estate taxes to go up?
Ah, good question. I get it all the time. The short answer is no. Okay, when you refinance your property, you're not transferring title. And that is the trigger in the majority of cases for when you will incur a reassessment of the value of your home, the tax basis of your home. When you refi, you're on title before, you're on title after, and you don't generally have to worry about that. So those that have a concern, and there are a lot of them, a lot of folks out there who do, no. In California, refinancing a home will typically not trigger a reassessment.
So Prop 13 basically says that it can only go up 2% a year.
Right.
However, Prop 8, people were able to reduce their taxes when values dropped.
Right.
Temporarily.
Yeah.
They can go up, not 2% a year from there, but they can go all
from
the way
back
up to the original basis.
Right.
And start again. So the refinancing, you're saying, even if with the Prop 8,
right.
I mean, they don't have to subject themselves to the tax assessor. With that.
Correct. And sometimes you hear stories of people saying, no, my taxes did go up, and it is in fact what you just described, Edward, where they were unaware that it had been temporarily reduced, and then it just coincided.
Well, they weren't unaware. I'm sure that they get their tax bills down, they were aware.
Yeah, but people tend to appreciate that kind of thing.
That's
true. They don't call the assessor and say, hey, my taxes went down. But yeah, so what you see there, one thing I will say about this is that a lot of people will then also come back and say, well, hey, I hold my property in a trust. What happens then? If I come out of the trust and then I go back into the trust. Again, if the trustee is... you don't have a transfer of title if you're dealing with the trustee.
It's not a third party.
Right, right.
Rob, are you referring to a grantor trustee, which is typically a revocable trust?
Right, exactly. Correct, exactly, Mike. And so we see that most frequently, and then when you have that. And another little, sort of ancillary point on all this is that you have to be especially careful, however, when you're refinancing. If anybody is coming off the title or going on to the title of the home, you could incur transfer tax. Okay, which is something that's caught a lot more people up in Marin County here recently, for whatever reason. And lenders are especially sensitive to this now because the Mortgage Disclosure Improvement Act several years back and the GFE 2010 make the disclosure of transfer tax a zero tolerance item. That means if we do not disclose transfer tax and it later comes up for any reason, the lender has to pay it.
That's good for the homeowner.
Exactly.
Wow. Not good for you.
Yeah, and so it's if you're a consumer out there and your lender is disclosing transfer tax on your initial disclosures, just know that sometimes that will not be the case. They're being overly protective to stay within compliance.
Because that's a pretty expensive thing, that transfer tax.
Can be very easily be several $1,000s, and to compound that with the Dodd-Frank regulation, which then states that the bank can be compensated a certain amount per deal, regardless of whether that revenue is generated. If there is a $2,000 compensation in that loan and a $5,000 transfer tax, the lender's now in the whole $3,000. They don't like to be in that position.
They just make it up and follow you.
Right. So again, all these things tie into your disclosures and the way your title is either transferred or not. But in the case of a refinance, you're generally safe.
Okay. What are you finding rates nowadays?
Rates are up a little bit from where they were a couple weeks back. And the reason for that was the fairly decent jobs number that was 2 weeks ago Friday. That's caused rates to tick up anywhere from 0.25%. But still, we are, I wouldn't say we were at previously at about 21-month lows. We're just off of that now. So still very favorable. 30-year fixed rate loans under 4%. 15-year fixed rate loans in the low to mid threes on most loan sizes.
Okay. Well, you're a very sharp mortgage broker, which is why
I just can't do any math. But
yeah, that's right. That's why we have it on the best of investing. People want to look at doing refinances or just purchasing.
Yeah, sure.
Loan from a bank.
RPM Mortgage is the company I work with or work for. We are located in Mill Valley. Our branch is 415-367-5959 is my number. Also can find my bio on Best of Investing.
Okay. Do we have time for me to ask Rob a question?
Yeah, sure.
Okay. Rob, do you find a lot of lending, that you're doing a lot of lending with non-owner occupied properties or second homes? Or
I wish I had brought in, I had a document that showed the percentage of ownership that is primary, secondary, and non-owner occupied. We do quite a bit of non-owner occupied. Second homes far less. That would be the least of the three.
I don't know, I can afford them now.
Yeah, and second homes are generally treated like primary homes, but we don't do, I would say it makes up 20% of my overall business. So by far primary, and that's what the stats bear out as well.
Okay. Mark, I want to move over to you here. Email we got. Interest rates seem to be dropping a bit. except for what Rob just
Yeah,
mentioned.
I mean, in general, that's true.
Okay. Are you still able to make loans at over 8%?
So interesting about when it comes to the hard money or private money lending industry, rates are not
Market.
well. They're not as market driven.
Right.
I mean, there are market forces, and the market forces in Bay Area hard money lending have to do with the amount of money that's out there looking to be invested in the types of loans we do. So what do I mean by that? Well, the San Francisco Bay Area actually has some of the least expensive hard money real estate loans in the country. So in other parts of the country, 12, 14,
Wow.
16, even 18% is not unusual rates for a hard money loan. And I'm talking about like Detroit, Atlanta, Phoenix, Texas. These are all much more expensive for a hard money loan than it is in the San Francisco Bay Area. And in fact, Southern California is more expensive than Northern California when it comes to hard money.
Is that due to average loan size?
Well, I was going to ask, does it also have to do with the perceived risk in those areas?
I think it does. It absolutely does. With loan, it's you're both right. So the loan sizes are much larger in the Bay Area than they are in other parts of the country, and the perception of stability and value is much greater here in the Bay Area. So we do have cheaper hard money in the Bay Area than other parts of the country, but it's driven mostly by how much money is there willing to invest in those types of loans here in the Bay Area. Not so much whether the jobs forecast has gone up or whether the 10-year T-bill rate
Right.
or the price of gas or any of that stuff. And in fact, a lot of people who have been playing the trust deed investing or mortgage pool investing game for years or even decades, many of them intuitively are factoring for approximately an 8 to 10% yield on their money. I mean, that's historically been pretty compelling for them to lend their money out at. So the answer is, I guess, to the question is no. It really isn't. It's there are
So
different
you're
forces.
still able to. Well, the question was, are you still able to make loans at over 8%?
Oh, of course.
Yeah.
So to answer that question, the answer is yes. We are able to make loans at 8, 9, 10, sometimes 11 or 12 if it's a second. So really, it's when we price a loan, we price it more on how much work do we think it's going to be, how many hours will we spend in order to originate and find an investor for that loan. I mean, first it has to pass the sniff test. Do we like the loan? Does it fit within our overall general lending guidelines? Is it, for example, is it below 70% loan to value? Is there an ability to repay? Do they have a good exit strategy? They being the borrower, all of those things. But then it gets down to how long, how many days, how many hours do we think we're going to have to spend in, and how many investors will we have to show this to? Because the less compelling the loan, the pricier it's going to be.
Very good. And how do people get a hold of you for earning over 8%?
So our company is Pacific Private Money. We're located right here in the Bay Area. We're at pacificprivatemoney.com. That's our website. And our phone number is 415-883-2150. Again, 415-883-2150 to find out information about how you can borrow money from a non-bank resource if you're a real estate investor or if you're looking to invest capital for an 8% approximate return on your capital. Give us a call.
Very good. When we come back from the, we're going to go to another commercial break. When we come back, we've got an interesting email for Mike that has to do with paying, how much about finding out what am I paying for my investments, because everything's got a built-in cost, and then we've got some interesting articles to go over. So here, what word is defined in geometry as a straight line that touches a curve, but continues on without crossing it? So what we're talking about is a straight line that touches a curved line. But it continues without crossing it. All right?
I feel just like I'm back in high school.
Back in high school, baby. Okay, the first three callers with the correct answer win a free 3-day 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer that question. All right? I'm not going to repeat it because I don't understand it. All right, stay with us. The best of investing. We'll be right back.
Curvilinear.
Oh, there you go.
It's the only
What
word
is it
I know
called?
that has curve and line, curvilinear, but I have no idea if it's right. Edward's a big poker face.
Yeah,
That's
he's
I'm a poker face, baby. Okay. Skip this.
But it's probably. Well, I'm afraid I'm going to flunk this class here.
Poker face.
I'm already at an F, right?
I'm
I'm
not a cheat
50-50,
sheet, I would have known.
How many? Mark, you were good in math, weren't you?
I was. It's like 40 years ago.
Yeah.
Did you go to Drake?
I did.
What year did you graduate?
78.
Boy, 40 years ago.
You
I
didn't go
mean,
to
never
Drake.
past
Did you go to
10.
Drake?
No,
you went to
Carolina.
Carolina.
Wow.
Yeah, when I was little, it was just 1, 2, and more than 2. That's it. How much does a house cost? More than 2.
Just talking to a guy today who bought his house in Mill Valley, it's Folkestone anyway, on Lovell.
Yeah.
Paid $16K.
Oh, yeah. There was nothing fancy about it.
No, I know,
Back in the
I know.
day. In the
Yeah.
60s.
You look at those pictures from the Dipsy race, and you know all of the people there at the. It's just like it was a backwater.
Yeah.
I mean,
My parents in 1962
working class town.
bought
I mean,
their-
you know.
in San Rafael, in Marinwood, bought it for $13,000.
Yeah.
And then in '68 sold it for $26,000.
Yeah.
And then they
Yeah.
bought the one that my sister bought my mom for $40,000.
I got a guy in the city right now who's refinancing a property. It's worth $3 million. He owes 1.4 on it. He bought the place in '81. His tax basis, he's paying $4,200 a year.
So
If he were readjusted, he wouldn't qualify for the loan.
Yeah.
I mean,
And that you don't have to worry about because unless he
No,
adds somebody in.
yeah, no.
Yeah, I guess is that a question that people say? Well, what if I want to add someone on title?
that wouldn't change your tax basis. You'd be push claiming them on, but you wouldn't.
Now, if you do any kind of remodeling and get a building permit, can they,
Oh, yeah,
can they
that
nail
goes
you
up.
completion on
But
it?
only on the
Ad
I'm
valorem.
an expert, but
on that part.
Yeah, only on the ad valorem part.
Yeah.
Yeah.
which is why people always put down 1/5 of whatever the
Right.
cost
Yeah.
is.
Yeah. But they don't do it based on the
They
whole
do.
thing.
Every contractor
All right.
I've ever
Mark's got a
Of course, I wouldn't do that.
training session, right?
I do.
Can you help me get this fat off?
They bring you by for 10K. They say it's for 25. Right? The price for
Is this 3 or
Sure.
4?
Which one is
This
it?
is the last one. Oh, I gotta figure out how many segments are.
We're all a little bit greedy.
Well, who was it that said if
Oh,
you're
wow, we got
not
one.
corrupt, you're not really alive?
Einstein?
The guy who came in second in the Nobel Prize.
If you're not corrupt, you're not really alive?
Something
Someone
like
said that?
Yeah, I know. It's hard to believe somebody
That's
said that.
stupid.
Sounds like Al Capone.
Well, no,
Yeah.
well, it's something. Yeah. Well,
You gotta
don't
hold
quote
her-
me on that. It's not usually what I tell my clients. No, it was something more sophisticated than that. But,
Should
you know what? The
grab
point
your,
being, the
thing.
point being, if you're just
Yep.
too goody-goody,
Wow, we got a long
and too
segment.
straight laced, and you're hiding something about your true nature too, because
16
everybody
minutes.
in their true nature has a little bit of something.
We got 16 minutes.
Except-
We got a long segment.
Okay.
You should be on air right now talking about being corrupt.
You guys got enough stuff to carry you for 16 minutes?
I do.
Yeah, sure.
Okay. All right. Here we go. First, we'll go into. Welcome back to the best of investing. Last time for today, our last segment. I'm Edward Brown, your host. Mark Hahn of Pacific Private Money, California's fastest growing private mortgage investment firm. Rob Spinoza of RPM Mortgage and Mike Zaylin of the Drone Investment Advisory on air with you today.
We're all here.
We're all here. Okay, so here is our third and final math question. What word is defined in geometry as a straight line that touches a curve but continues on without crossing it?
Mike had it.
I thought it was curvilinear.
No. Now I'll repeat the question, but I'm going to add
Oh,
one thing.
please.
What T word is defined in geometry as a straight line that touches a curve?
T word.
Starts with a T.
Transgender.
Close. Tangent.
Ah!
Remember that? A curved line and a line that touches it and continues on. Okay. So, Mike, we have a trivia. We have a very important email.
No more
Not-
trivia.
not-
No more trivia.
Okay, we got some calculus questions for you. No. Okay, so here's a question for you. It comes in and says, how can I find, because this person obviously has heard you on the air before talking about fees and all this stuff. How can I find out what I'm paying for my investments and why should I care?
Well, there are about 3 or 4 different categories that you could be paying for. One is how much you're paying your advisor, and sometimes that you can usually find that somewhere in your contract or your brokerage agreement or your advisory agreement. That is often 1%. It could be more. Then, in addition, if you own mutual funds, you can always go to Morningstar, type in the ticker symbol for your mutual fund, or if it's an exchange-traded fund, it's going to be a 3-letter symbol. If it's a mutual fund, it'll be a 5 letters. And Morningstar will just kick out the expense ratio. But that's only part of the story of what you're paying for your mutual funds. Expense ratios don't include a lot of other costs like transaction costs and about 3 other costs in there. And so the typical rule of thumb is, depending on how much turnover is in the mutual funds can, on an average, turn over about 80% of their portfolio a year. And that adds a lot of transaction costs. So the rule of thumb is roughly another 0.5% in costs to the expense ratio, and that tends to bring them up to the general 1.5 to 1.75%.
Is there a general rule of thumb that you like to see for a portfolio turnover?
The ideal portfolio turnover to me is no portfolio turnover, because portfolio turnover leads to taxes if it's in a taxable account. So when I say that, I'm really saying that it's very passive index funds that are probably going to be the best long-term investment versus actively managed mutual funds. There's much less turnover. The average index fund turns over something like 5 to 10% of its portfolio. Now, in an IRA or Roth, that's not going to matter that much, except that there will be some inherent fees in that, but they're not going to be as high. But in a taxable account, it'll really matter, because anytime there's turnover, you're going to get, unless the mutual fund itself can take advantage of a loss by, in other words, a tax managed account. That's much harder to do in a rising market where the losses. So the studies have generally shown that taxes in mutual funds pretty much subtract about 1% a year from your return. Given that the difference between a 6 and a 7% return can easily be about 20% of everything you're going to make, that's really significant, and that's why I personally favor passive index funds over actively managed funds. It would be one thing if the actively managed funds had a track record of beating index funds, but every study I've seen shows that it's about the odds are about 80 to 95% that it's not going to happen. It's not going to happen. 80 to 95% of the time, the index fund will beat the performance of the mutual fund over a long period of time.
But just in general, how often do portfolio managers beat the S&P 500 as an example?
Well, exactly, and that's about 15, 20% of the time over 10 years. The problem is you'll never know whether that was skill or luck. It could have just been random.
Yeah, I was going to say, how do those guys keep their
jobs? You would never know, and that's why when you get a 5-star rating from Morningstar for doing that, Morningstar specifically says that these are only indicative of past performance and have no bearing on future performance, because I think the average 5-star fund is no longer a 5-star fund after 13 months.
That's why baseball players should get paid the same. Hey, past performance, what have you done for me lately? What are you going to do in the future?
What I was going to say about that, Edward, what you just brought up, is that it's not about keeping your job, it's about keeping your bonus. On Wall Street. I mean, so the job is transitory, right? A lot of those cases.
Yeah, very.
I've got an article that I think Mike will appreciate, that speaks a little bit to what you've been talking about just now, and of course in the past several shows, and it's from an opinion piece that came out in the North Bay Business Journal that I found really interesting, and it's titled "Take Care with Economists' Market Forecasts," and it talks about that year after year economists consistently get it wrong, and they tend to confuse investors with their logical sounding economic analysis and forecasts. Wall Street has always tried to sell Main Street on the idea that experts can consistently time the market and make accurate predictions of when to buy and sell, but the numbers indicate that they cannot. And history has proven time and again that economic market analysis may actually be the cause of below average investment results. We all want to believe that someone has definitive answers, but the truth is that the economy is made up of extremely complex and constantly changing variables which human brains are ill-equipped to evaluate.
Well, that's a really good point, and I can't remember where I read it, but there is a huge difference in expert systems. So, for example, being a chess player, it's not random. The better chess player will beat the worst chess player. But in complex chaos systems like economies, where there's so many different factors, there is really no expertise particularly. And that's one reason why Very, very few mutual fund managers or stock pickers have ever beaten what what an index can do.
I mean, it's one thing to try to figure out what company is good to invest in, but it's
Right.
also the timing of the market. I mean, if the market is crashing,
Right.
it doesn't matter how good your company
Or a company in what, like Shell Oil, maybe a good company at one period in time, but not in the
Exactly.
current environment. I mean,
Yeah.
one thing exactly. One thing I wanted to say is that I think a listener out there right now could very easily take what we're saying and say, well, okay, well, screw all these experts. You know, none of them have any. What do they know?
Yeah.
But I will say personally that in my line of work, I'm in mortgage. Very many people come to us and have complex questions that have not been thought through properly through no fault of their own. They just are not educated about the forces that affect their approval. And in that case, I think in every case, and most of you guys would probably agree with this, do seek an expert. Because I think if you're talking to someone that you know comes with a reputation, that you trust, for whatever reason, however you go ahead and shop for any service, I think that insight can be very valuable. You still have to make the decision.
Well, yeah, but you also, I mean, you gotta agree with that because
Yeah,
you have to
yeah.
decide the government bonds.
Right.
You can all talk about index funds,
Right,
let's say,
right.
but government ones, munis,
Right.
But what we were talking about really was just prediction.
Sure,
The inability
sure.
to be an expert in that. Clearly, there's value in getting expert advice on
Well,
mortgages, tax planning.
Right, and I think a lot of people here, they say, oh, financial advisor, mortgage planner, I don't need these guys, I can just go on the internet and do it myself. And I think that what we're talking about really speaks to the complexity and appreciating and understanding that complexity on a different level.
Right, and so let's talk about mortgage interest or interest rates. So the Wall Street
Let me tell you where they're going.
Well, the Wall Street Journal reported in December of 2013 that 45 of 46 economists agreed that interest rates would rise in 2014. What happened? They didn't. And apparently, investors withdrew 170 billion out of bond funds from June of 2014 through December last year, partially because they believed interest rates were going up, and they didn't.
Well, didn't the QE, was it, whoever
Ended,
the,
right.
Yeah, they
That
ended,
ended,
they said,
right,
yeah, we're going to
right.
keep interest rates down until 2014. This was a few years ago, so they.
Well, I knew interest rates were going down because I subscribed to an advisory newsletter put out by the New York taxi drivers.
Yeah.
They've never been wrong.
Yes. I would agree with that one.
So predictions, are she ends the article here. Wall Street Index has predicted 9 out of the last 5 recessions.
Yeah, isn't that the truth?
And Mark, it's funny, but people are always often getting in and out of the market. They hear something, and I get calls all the time from someone saying, "I heard this person on TV saying it's time to get out." And one very long-term study showed that there's far more damage to investors' portfolio through market timing than there ever was through market crashes.
I remember in the old days looking at some statistics like that, and it's ridiculous. If you miss just like 7 days,
Right.
That are
sit out the 7 best days. Yeah.
Exactly. It's amazing that the devastation.
The most amazing statistic I've ever seen was that Peter Lynch, who ran the Magellan Fund,
Right.
The average investor in that fund actually lost money in the years he was managing it.
Really?
Because most of the time people were getting in it at the top.
Oh,
and
yeah.
at the bottom, which
Because
is a truly amazing fact.
Yeah, because he was the man in
Exactly.
the 80s.
But human psychology shot everyone in the foot.
Yeah.
Had they just bought and hold, and I think over the last 40 years, the U.S. market has compounded at about 9% a year. The average investors are 3.5 or 4, getting in at the top and out at the bottom.
Now, didn't something happen with Magellan in was it the 90s or something? It totally.
I think it became one of the worst performing funds, I believe, after he left for a while. I'm not exactly sure, so I'm not really sure about something like that.
So market timing, market predictions. If you're a long-term investor, and you should be,
You really should be, not because it's guaranteed, just because it's your better
Okay,
option.
I want to be a long-term investor, but should I get in now or should I wait?
Well, I'll have to talk to the New York taxi driver.
Exactly. Rob, you got another little
I just brought some infographics. I kind of like these things they come across, and I wanted to just throw a little pop
Show it
quiz
to
to
the television audience.
well, it's black and white. I'm sorry about that.
That's all right.
But this one is the most interesting to just cover in a couple of minutes. Where are Americans moving? So what states are losing and what states are gaining?
Okay.
What do you think the number 1 state is?
Oh, gaining or losing?
Gaining, sorry.
Texas.
Yeah,
That's on the
that,
list.
yeah.
Texas is on the list,
But
but it's not number one.
California, I think, is still growing, isn't it?
Oregon, number one.
Oh, people going from California to Oregon, probably.
Yeah, probably true there. And what do you think is the number one state moving out of?
Florida or Mississippi, Alabama.
None of the Deep South is on there.
Oh wow, okay.
Yeah, I don't see
Maine.
New Jersey, number one.
Really?
People don't want to live in New Jersey?
I can't believe it. New Jersey, New York, and Illinois are the top three.
I wonder if that has to do with tax burdens when people retire.
Good point.
Yeah.
Good point.
Oh, yeah.
Which is a problem California will face too.
And Connecticut's pretty gnarly with their taxes.
Connecticut is number 10 on moving out. Yeah. Well, I'm moving out. Yeah, this is pretty interesting. One of the ones Mark mentioned, Texas, that is a moving in. That moving in number 7. Florida is number 5 moving into.
Well,
so
they're very friendly. You know,
Yeah.
well, I mean, no,
Yeah.
I just don't mean.
I was trying to think of the tagline for the state.
Yeah. No,
Well,
but
do you find that you have a lot of transactions with people who are moving out of state to when they retire, or?
Well, the great question. We don't see a lot of that because I'm only licensed in the state of California. I don't see as many moving in as you would think. We do see some moving in from the East Coast, which is always nice, and our job market is robust here, so that helps.
yeah, it's interesting. You don't see California moving in or moving out.
Yeah,
So
yeah.
the rush from people from Mexico isn't coming in anymore. A lot of people are going back to Mexico.
Well, but a very interesting infographic on some of the states that you might expect. I don't see Michigan on the moving out, so I'm sure they're happy about that. At least not the top 10. I know that they had a huge brain drain there a few years ago. And then some other stuff in there, just talking about.
I like this one you had here about homeownership rates. Are they crashing? Because again, the news loves to, if it bleeds, it leads, right? And to believe the news media, homeownership rates are crashing because they've been decreasing since the high from December of 2004, when in fact today they're basically at the average they've been for over 30 years.
Right, and so the home ownership rate has been around 64% since 1984, and in 2004, December of 2004, it was 69.2. So this
why was it 69.2
well, okay.
2004?
So let's step back a
Easy,
second.
free money?
Yeah, exactly.
Almost free?
Preponderance of
Liar
interest-only, stated income loans, things like that. Everybody could get it. Not everybody, but a lot of people could get into the market with very little down and very little income documentation. And that certainly did increase and augment the.
We had a credit bubble, and we almost
right.
hit 70% homeownership rate, which on the face of it is great news if 70% of the public is able to own a home, but the underlying economic fundamentals could not support that long term.
But also to your point, Mark, that you could very easily make a case here and say in 30 years the home ownership rate is the lowest it's ever been, and in '84 it was 64.1, and in 2014 it's 64.0. You would be right.
What about gold? Anybody interested in gold?
I haven't looked in a while.
I don't know, just
Gold?
it skyrocketed, then went down, skyrocketed, now
One
went
of the
down.
really telling statistics about gold is Robert Shiller, the famous economist who came out, I think, with the rational exuberance, did a study showing that from 1800, in the year 1800, if you had invested $1 in, if there had been an S&P 500 index fund, you had invested in that, or the 10-year Treasury, or gold, 215 years later, the stocks would have been worth, I think it was $3 million. The dollar invested in treasuries would have been worth, I think, $40,000, and gold, the dollar in gold would have been worth $30, which goes to the fact that gold has historically only kept up with inflation.
Yeah.
Has no rate of return because it's not a business.
That was the other joke about gold. What did the guy say? In 1900, gold would have gotten you a really nice suit.
Yeah,
and
the same way.
an ounce of gold would have gotten you. Yeah, exactly.
Okay, guys, it's a good show today. Thoughts for the day. There is only one boss, the consumer, or the customer, and he can fire everybody in the company from the chairman on down simply by spending his money somewhere else. Who said that? Sam Walton. Smart guy. I heard of him.
Yep.
And Winston Churchill said, some people regard private enterprise as a predatory tiger to be shot. Others look on it as a cow they can milk. Not enough people see it as a healthy horse pulling a sturdy wagon. I thought that was kind of interesting. Okay, tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.